CTRIUM boasts a 17.8 billion Singapore dollar order book, but underneath that massive headline lies an uncomfortable truth. A 1.24% yield fails to beat even the baseline CPF ordinary account. If you are allocating your SRS or cash portfolio toward this turnaround narrative, your capital is absorbing immense engineering risk for a fraction of the risk-free rate. I have been watching this ticker for a while, and the number that finally made me sit up was the gearing figure. This is one of those pieces where I had to run the data twice because I simply did not believe the discrepancy between the headline hype and the forensic reality the first time. CTRIUM has delivered a dramatic improvement on the top line, 11.5 billion Singapore dollars in revenue and 324 million Singapore dollars in net profit. On paper, the core business is finally producing cash, and institutional money is celebrating a positive free cash flow. But when we apply our forensic baseline, the reality bites back quickly. That cash is not making its way to your brokerage account. Management is retaining the vast majority of capital to build an empire, while retail shareholders bear the heavy integration risks. You are effectively funding their turnaround with your personal opportunity cost. We have to look past the dashboard green lights and focus on the structural issues that threaten long-term stability. The immediate question is whether this is a yield trap masquerading as true growth. The headline numbers present a massive 17.8 billion Singapore dollar order book, which sounds like absolute institutional security. But the 1.24% dividend yield tells a completely different story. For a retail investor deploying SRS capital, you are absorbing immense engineering and execution risk for a fraction of the guaranteed CPF baseline. The top-line revenue and profit recovery appear promising on the surface. That optimism vanishes the moment you contrast the margin profile with the lack of a meaningful dividend payout. We have to audit whether the margins truly justify holding this equity through a multi-year turnaround. The contrast between the top and bottom of the metrics table is stark. Revenue and net profit both passed the initial test with massive year-over-year growth. But the forensic reality emerges in the final three rows. The gross margin sits at a tight 7.4%, which fails our 10% sector benchmark. The gearing ratio of 0.4 times breaches our strict safety ceiling, meaning the balance sheet carries too much leverage for a low-margin business. And the 1.24% dividend yield is an absolute failure against our minimum hurdles. A multi-billion-dollar order book is forensically meaningless if the underlying yield cannot even buy you a cup of kopi. Which brings us to the forensic gap that separates institutional expectations from your retail reality. The market is pricing this equity on a 32 billion Singapore dollar pipeline of future deals. Institutional investors celebrate the positive free cash flow because their timelines and mandates are entirely different from yours. For the retail investor, the reality is that you are handed a pitifully thin distribution. Management retains the capital. Your personal cost is full integration risk combined with a massive opportunity cost. The core business is finally producing cash, but that cash stays locked inside the corporate treasury. The gap between the headlines you read and the cash you actually receive is the defining risk of holding this stock today. Tracking the dividend trajectory reveals exactly how painful this has been for early believers. This is not an income story. This has been a survival timeline. From fiscal year 2021 through 2023, shareholders endured 3 consecutive zero dividend years amid massive net losses. Fiscal year 2024 saw the first full-year profit and a 1.5 cent distribution. The proposed 3.0 cent payout for fiscal year 2025 still represents a payout ratio of just 32%. Management is keeping the lion's share of the earnings. If you are an income investor relying on steady cash flow, this historical record proves your capital has been entirely uncompensated for years. That dividend trajectory confirms this is a slow crawl back toward relevance. After 3 consecutive zero dividend years, the proposed doubling to 3 cents is directionally positive, but we cannot ignore that 32% payout ratio. Management retains the absolute majority of earnings to repair the balance sheet and fund future operations. For income investors managing retirement accounts, this is simply not a recovery story you can depend on. You cannot fund your daily living expenses on the promise that a turnaround might eventually yield a proper distribution 5 years down the road. The capital is locked in a slow rebuild, offering a fraction of the returns you could secure elsewhere with zero structural risk. Now let's look at the bull case. The first undeniable positive is massive revenue visibility. CTRIUM holds a 17.8 billion Singapore dollar net order book securing operations all the way through 2033. That figure dramatically surpasses the historical averages of its predecessor entities and puts them in the same elite tier as ST Engineering, which holds a 28 billion Singapore dollar order book. If global oil macro conditions see a 10% lift, deep water projects will accelerate, potentially driving a total shareholder return greater than 15% and beating the CPF special account floor. But this bull case only holds if the 32 billion Singapore dollar forward pipeline converts at a rate of at least 5 billion Singapore dollars annually over the next 24 months. The second positive is series build margin expansion. The strategic pivot toward repeatable designs across 95% of the order book pushed gross margin from 3.1% up to 7.4%. That is a structural improvement, a verified raw fact. A 10% operational efficiency gain across current projects could add an estimated 50 million Singapore dollars directly to the bottom line without additional capital expenditure. But while they are moving in the right direction, 7.4% still fails our 10% sector benchmark, especially when peers like Yangjiang Shipbuilding run at 34.2%. This bull case only holds if gross margins breach 9.5% by the fiscal year 2026 full-year earnings report. The third positive is a genuine defensive bright spot on the balance sheet. The interest coverage ratio stands at an impressive 8.7 times. That cleanly beats our 4.0 times fortress balance sheet threshold and completely eclipses the negative averages of its predecessor entities. It even offers superior debt servicing headroom compared to ST Engineering's stable 5.7 times ratio, even if we stress test the 10% spike in global borrowing costs. This buffer protects core operations and shields equity holders from unexpected dilution or emergency rights issues. They are generating more than enough operational cash to pay their bankers. This bull case holds as long as the interest coverage ratio remains strictly above 6.0 times during upcoming multi-currency debt issuances. Now we must confront the bear case. The first major failure is the forward dividend yield, a dismal 1.24%. This raw fact is mathematically hostile to retirees and violently fails our 4.7% minimum yield hurdle. Yangjiang Shipbuilding operates with a net cash balance sheet and yields nearly 5%. If you deploy a 100,000 Singapore dollar ordinary account position here, you face a net yield gap of negative 1,260 Singapore dollars per year compared to doing absolutely nothing. Your opportunity cost compounds silently while you take on severe maritime execution risk for less than a fixed deposit rate. This red flag only clears if management guarantees a minimum 4.0% yield by fiscal year 2027. The second major red flag is the elevated gearing burden. The debt-to-equity ratio sits at 0.4 times, which immediately breaches our strict 35% gearing ceiling required for a true fortress balance sheet. While peers like ST Engineering carry higher nominal debt, they are backed by stable aerospace cash flows. SEATRIUM has highly cyclical revenues and no such luxury. If SORA rises by 50 basis points, the resulting interest expense strips away distributable cash and compresses your already incredibly thin dividend. They are carrying far too much leverage for a low-margin business. This structural red flag clears only if the gearing ratio is aggressively paid down below 0.35 times before the next major debt maturity window. The final red flag exposes the earnings quality distortion. The headline claims a 324 million Singapore dollar net profit, but management inflated that figure with a one-off 104.8 million Singapore dollar gain from an asset sale. Strip it out and the underlying organic earnings base is alarmingly weak. Think of it this way. The drink stall uncle claims a record profit, but his ledger shows he just sold his second espresso machine for cash. Next month, he has no more machines to sell. A 10% plunge in energy prices could expose this weak organic base and drive the share price down aggressively. This clears only if they deliver 350 million Singapore dollars in pure organic net profit by fiscal year 2026. If you are managing your own capital and want the unvarnished data before the market reacts, Iggy's elite investors get zero-day access to these full forensic models. The link to join is in the description. The peer comparison data paints a very clear picture. SEATRIUM sits at a 1.24% yield and 0.4 times gearing, failing both critical gates. Yangjiang Shipbuilding passes with a forward yield near 4.8% and zero gearing. ST Engineering provides a stable 4.0% yield while easily passing the interest coverage gate. Sembcorp sits on the borderline for yield but deploys its debt into power purchase agreement-backed capacity. SEATRIUM is structurally isolated at the bottom of this peer group when it comes to rewarding shareholders. All the evidence points to one uncomfortable verdict. SEATRIUM is the only entity in this peer group that fails both the minimum yield gate and the gearing gate simultaneously, while carrying the thinnest gross margins in the sector. Yangjiang operates with net cash and converges toward our yield hurdle. ST Engineering provides a solid 4.0% yield backed by a stable 5.7 times interest coverage ratio. Sembcorp deploys its leverage into secure renewable capacity. SEATRIUM currently possesses none of those structural defenses. The operational integration might have stopped the corporate bleeding, but it has not translated into shareholder wealth. You are holding the risk of a massive industrial turnaround without the necessary compensation to protect your portfolio. The Singaporean stress test reveals the true mathematical cost of holding this equity. We take the asset yield of 1.24% and subtract the current T-bill rate to find a deeply negative risk premium. For this audit, I apply a conservative forensic floor of 3.2%. We audit for the storm, not just the sunny day. I do not lower my standards to match a temporary market dip. My floor remains at 3.2% to ensure sanctuary assets can withstand a return to long-term average interest rates. When you add the 150 basis points of mandatory risk premium, the minimum yield hurdle is strictly 4.7%. Compared against the 4.0% CPF special account floor, the conclusion is absolute. The equity risk you are taking is entirely uncompensated by the current dividend stream. Before we map out exactly who should and should not be holding this asset, let's be direct about why we run these brutal numbers. You are not here for the random copy tips or the social media hype that constantly surrounds this ticker. You are here because you want the absolute forensic truth before you commit a single dollar of your hard-earned capital. A massive headline order book means absolutely nothing if the balance sheet cannot convert those projects into distributable cash. We strip away the corporate narrative to protect your principal, ensuring you only take risks where the mathematical upside aggressively outpaces the downside exposure. Every forensic investor who watches these breakdowns without subscribing remains completely invisible to the algorithm. The machine only sees one signal, whether you have hit subscribe. If this objective, data-driven analysis helped you identify a hidden risk in your portfolio or calculate a proper margin of safety, take 2 seconds to subscribe for free. Share this breakdown with one person who needs to hear it. That tells the platform that rigorous SGX analysis deserves a permanent seat at the table. Placing all the evidence on the forensic weighing scale, we can clearly separate the operational successes from the financial failures. What has worked is the massive integration effort. They stopped the bleeding, aggregated an incredible 17.8 billion Singapore dollar order book, and are successfully executing complex engineering projects on a global scale. What has not worked is the translation of that effort into shareholder value. The margins remain brutally thin. The balance sheet leverage is uncomfortably high. And while the dividend is technically growing, it remains forensically inadequate. The machines are running, but the investors are still starving. The wallet impact is direct. The 62-year-old in Toa Payoh managing their SRS drawdown has absolutely no business holding this equity. The 1.24% yield cannot sustain retirement cash flows, meaning you will be forced to sell shares to generate income, which actively destroys your capital base in a sideways market. This stock suits the 45-year-old investor with a 15-year horizon, using spare cash strictly outside the CPF system and only under the absolute condition that the 32 billion Singapore dollar future pipeline is secured at gross margins exceeding 10%. The single forensic factor tipping the balance here is the illusion of turnaround completion, which brings us to the yield trap reality. A positive net profit does not mean a company has magically returned to its former blue chip glory. It simply means the entity has stopped dying. The market is currently pricing this equity like a finished product. But the 0.4 times gearing ratio and the 7.4% gross margin scream that this is still a highly active construction zone. Do not confuse a mere cessation of losses with a return to dominance. Paying a premium price for a turnaround before the dividends actually return is just donating your capital to a corporate restructuring plan. Looking ahead to the next major refinancing window, you have to ask yourself a very difficult question. Does your portfolio have the patience to hold dead money for another 3 years? If this maritime giant fails to expand its gross margin past the critical 9.5% threshold by the next earnings call, the share price will likely stagnate while your capital is trapped. You are absorbing the daily volatility of the energy sector without receiving the cash distributions required to offset that anxiety. If your investment strategy relies on compound interest and steady payouts, waiting 3 years for a potential recovery is an opportunity cost that most retail portfolios simply cannot afford to pay. The consolidated operating model for SEATRIUM is mathematically viable, but the current equity pricing demands absolute perfection in execution. When a company yields significantly less than a risk-free government bond, every single engineering delay becomes a direct threat to your principal capital. I am Iggy, forensic investor ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. The red flags were always there. You cannot afford to wait for the 7-day embargo window to lift when capital destruction is on the line. Join Iggy's elite investors using the link in the description to protect your wealth today. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.